Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So we're just going to do another Velocity Banking review for today. But before we get started, I just wanted to bring this up. So do you remember these Ty Lopez ads from a long time ago here in my garage, where he just kind of films himself in his garage and then casually points to a Lamborghini? And that's kind of like his way to sell online courses. Well, I'm kind of going to do the same thing too, right? So here in my YouTube community feed, I'm just looking at my paid off mortgage under 3 years. I don't have a Lamborghini in my garage, but I'm just in front of my computer staring at my paid off mortgage in 3 years. And we'll talk about velocity banking. Because what is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account. And you'll be able to get to a point, hopefully, to be able to pay off your mortgage quickly or quicker than your peers. And so I did it under 3 years. And how do you know if I did it under 3 years? You take a look at this mortgage maturity date, 2051. The start date is 11/1/2021. And then you can see here what July 29, 2024. So I did it under 3 years, right? So here I am in my in front of my computer just staring at this. And yeah, let's just do another velocity banking review. So what is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account. And do you know what a line of credit is? Because I have a friend who actually owns real estate and he had no idea what a line of credit was. I was like, "What's a line of credit? What's a HELOC?" And he bought a property in Los Angeles for $400,000, a condo, and I think it appreciated to $700,000 or $800,000. Still had no clue what a line of credit was, right? Because just because you own real estate, it's kind of like owning a car, right? It doesn't mean you're good at driving it unless you take some lessons or you're a little bit conscious about how to drive that car. It's the same thing with um, the tools available to us, right? Like a home equity line of credit. So, in order to do velocity banking, there's two things that we need. Number one is a budget, and number two is a line of credit as our main operating account. So we have a budget here, income, expenses, and we have pretty good savings, right? If you have $1,800 a month in savings, you're doing way better than the average bear. But we're just going to assume that this is what we're at right now, and we want to do even better. So we got two credit cards, a student loan, auto loan, and a mortgage, right? And one of the most important things that we have to understand about the mortgage, it's actually going to be the last loan that we pay off. So when we're at that point of our journey, oh my goodness, we'll be flooded with cash flow, so much cash flow, an explosion that all of our friends are going to be jealous, right? Because think about it. You tell other people that you paid off a mortgage under 3 years. Oh my goodness, they're you can kind of tell that they're going to be jealous, right? You'll create jealousy with the paid off mortgage, and then you'll just kind of casually tell your friends about that mortgage that's paid off under 3 years, just like Ty Lopez and his Lamborghini within his garage, right? All right, so let's keep continuing. So again, budget, line of credit is our main operating account, and we have $275,000 of debt. Now let's assume that we have a $50,000 line of credit available, 10%, right? So think of this as a credit card, and technically a credit card is a line of credit, but even more flexible because you just go to the bank's website and then you click a button and then you can withdraw up to $50,000 and they'll charge you interest. So a credit card, the biggest hurdle with doing this as a credit card is the high interest rates if you're not in that 0% interest rate period. And then number two, it's a little bit inflexible what you can pay. You can't pay one credit card with another, or a student loan, an auto loan, or a mortgage with a credit card unless you're using Plastique. And then Plastique is a little bit restrictive what you can use, right? You can't, Amex, I don't think you can pay any loans with that. So you got you Discover or MasterCard, and Visa you can't. It's kind of like in the same boat as Amex. You can't use it to pay any loans. But let's just assume we have a personal line or I don't know, home equity line of credit. And so, yeah, I know what a lot of you are thinking. Oh my goodness, who has a line of credit available? And this is why it's important to have a holistic education, kind of like Renatus. Guess what? It's like a feeder. This whole video is like a subliminal feeder to Renatus classes that I sell and make a commission off of. But one of the most important things that I understood about credit is that banks don't lend money to people who need it, so you need to get it before you ever need it, right? And so this is why I have like lines of credit laying around 15 grand, 280 grand. I think I have over $500,000 in lines of credit now. But I got to probably need to make a separate video about that. But the thing is we're going to assume we have access to a line of credit, And I know what a lot of you are thinking is that, how do I get it? Is, well, you got to get it before you ever need it because banks don't lend money to people who need it, right? And I'm like a parrot with that saying, but so many people treat banks like they treat restaurants. Like, I go to a restaurant because I'm hungry. Yeah, that's the appropriate time to go to a restaurant. But when it comes to a bank, you got to go to a bank when you don't need money, right? All right, so let's do the velocity banking side of this budget. So what we do is we assume that we have the same income and actually no savings. So this is the part where people feel totally uncomfortable doing this because think about it, tell your friends, tell your family, tell people that I have no savings. Every time I look at my checking or savings account, the balance is zero or very near zero. How comfortable do you think most people would feel? And they'd be like, well, you got to have an emergency fund. And I'm like, no, thanks, because my line of credit is my new emergency fund. And instead of savings, we're going to have something similar called cash flow, which is the same thing, income minus expenses, right? But when we make our line of credit as our main operating account, we're going to try to increase this number as much as possible, right? And so what the most no-brainer thing that we can do is move these two credit cards, and you'll see it's a $13,000 balance into this line of credit. Okay, so all we do is transfer the debt, but we haven't gotten rid of it. But guess what? At least we got rid of the payments, right? So this is zero, this is zero. And now we went from 1800 to 2200 on day one. And then the actual strategy is you put your entire paycheck, the entire 6,500 into the line of credit, and then you take your expenses out, and then after every single month, the balance goes down about $2,200, right? So let's go ahead and do that. And so, again, paycheck in, entire $6,500 in, $4,000 of expenses out, and then every single month the balance is going to go down by the previous month's, or we calculate the next month's balance by the previous month's balance plus the previous month's interest minus our cash flow 2268.54. And then what we do is we take the average daily balance. So let me get the averages right here as a way to estimate the interest, multiply it by the interest rate 0.1 and then divide by 12. And then now what we do is see how fast we can pay this off, and then we see that in 6 months it's paid off. So let me go ahead and highlight that. So 6 months we paid off 13K. Now we have 3 more loans. We made this simple review for today. We got a mortgage, we got an auto loan, and a student loan. So which one do you pay off first? I've done this a million times, so I know it's going to be the auto loan. But why the auto loan, right? And so one of the ways that we can figure out which loan we're going to focus on first is based on the cash flow, or what we call the cash flow index. So take a look at this. If I pay $22,000, I get $460 back in my cash flow. Whereas if I pay $400 back or $40,000, I only get $424 back in my cash flow. So which one do I prefer? I would prefer to get this cash flow because I only have to pay $22,000 for it, right? And so there's this thing called the cash flow index. So you can see right here, that's calculated based on the balance divided by the monthly payment, and then you get this number, and the lower the number, the better, right? The lower the number, the better. Okay, so luckily I have this loan calculator that tells me, all the good stuff about loans, how much interest I'm paying, what's the current balance. So how many months passed? 6 months. So I'm gonna put 6, 6, and then I'll put this right here. Okay, so now all I got to do is figure out what the balance is, and I know that I'm going to pay this auto loan, so we can easily pay this off by moving this balance into the line of credit. So let's go ahead and do that there. And then now I'm going to move this 21 grand into that line of credit, so 21910.1. And guess what? But just by simply moving this loan to the line of credit, what happens to this payment? This payment just goes away, just like we did with the credit cards. And now our cash flow is about 2,700. Oh my goodness, that's a lot of cash flow. So let me go ahead and replace this. So this would be 2732.53, right? 2732.53. And then what we do is we just kind of replace this, right? And let's go ahead and do that. And how long does it take us to pay off all this, right? It's 15 months until the auto loan is paid off. So we did that. So 15 months, and now it's 35K we paid off. And so now it's the next thing we got to pay off is probably the student loan. So let's take a look at our loans at 15 months. This one's paid off. And then 15, let me get 15. And so we have 36 grand in our student loan. And as you can see here, the amount of, what's it called? The cash flow index is very high. Like if you ever take a look at the scale, like 0 to 50 means you want to pay it off, 50 to 100 means and then like above 100 means you definitely want to pay it off last. But let's go ahead and move this, and then we'll just move this right here. And so the thing that's a little bit disappointing with the student loan is it does not take up that much cash flow. But we're going to get $400 back, so let's just go ahead and go put this to 0. And then 3,156.79. So let's go back here and oopsie. And then we're going to copy and paste. And then what we're going to do is put 3,156.79 as our new cash flow, and then just copy and paste and see how long it takes us to pay off that student loan. And then it's going to take us, as you can see here, 26 months. Woohoo! And then now, let me go ahead and scroll back. So this is going to be 26 months, and then 35 plus 30, 22K. So 35 plus 22 is 57K. And now the next thing we got to tackle is the mortgage. So let's see what the balance of the mortgage is at 26 months. So 26 right here. So as you can see here, this has an incredibly high cash flow index, 226, right? Anything above 100 is considered to be, quote, efficient, meaning that it takes up, the payment takes up so little compared to your cash flow. But be aware that with these efficient loans, you end up paying a lot of interest over the life of the loan. At 3%, it's about 50%. So you'll pay $100,000. Now, if you're able to invest this money, this leftover money, and get a greater return, go for it. But I think it might be easier just to pay off the debt. And so when it comes to a really highly efficient loan, you don't want to put the whole thing into a line of credit in general, right? And we have our trusty velocity banking calculator to kind of demonstrate this. What we want to do is what we call chopping it up in pieces, aka chunking, right? So let's say um, we take, let's say, $7,000 of this loan, and then this is going to be 193K, and then move it to the line of credit. Well, it will look something like this, right? So plus $7,000, okay? And then you'll notice within a couple of months, oh my goodness, that $7,000 got paid off pretty quickly, right? And then we just rinse and repeat over and over again. And luckily, we have a velocity banking calculator kind of like a cheat sheet to tell us what would happen based on the amount that we pay into the line of credit and how long it would take us and all of our other um, deets or details. So give me one moment to pull up the velocity banking calculator. Okay, here we go. So we got a Renatus velocity banking calculator, and you might ask, what is Renatus? Well, basically, it's the educational company where I learned velocity banking from originally. And full disclosure, this whole YouTube channel is just a sales funnel for Renatus products where I get commission for selling it. Okay. All right. So here we can see. So one of the things I want to demonstrate is the difference between doing the chunking method or replacing the entire balance of the loan with the line of credit. So you might have heard that in various other YouTube videos on the internet. So let's go ahead and do this. So if we chop it up into little pieces like 6,500, or we could even do 10,000, I think. So 10,000. Look at how much interest we pay. We pay about 14 grand of interest in total. Now let's go ahead and decide to replace the entire thing with the mortgage, this 3% mortgage, with a, we'll say 10% line of credit, so 190,792.08, and then you'll notice that we're paying actually more in interest and more in time. So that's why this method is actually, I can't find a single use case out of all the simulations where I've done where replacing your mortgage with a first lien HELOC would be beneficial compared to a second lien HELOC and just doing the chunking method, right? So let's go ahead and do this. And then we see right here, it takes us 4.3 years to pay it off. And that's what we're going to do, 4.3 years. So again, if you told other people that you know it only took you 4.3 years to pay off your mortgage, do you think they'd believe you? It's almost unbelievable because it takes the average person 30, 50, I don't even know, probably 50 something years to pay it off, right? So let's just go back here and then we're going to go here and then type in the number of months it took to pay off, which is 4.3 years. So actually I do this, 26 divided by 12 plus 4.3. All right, so 6.47 years and we're debt free, right? Awesome. That's $275,000 of debt free. And then you know what? If you're able to get to here and take a look at all the cash flow we have, $4,000 a month, that's a pretty sweet place to be. Now, here's the thing. You could actually argue that you don't want to pay off your mortgage that quickly because if you could invest into other things, you definitely should. The reason I decided to pay off my mortgage that quickly is because I just wanted that peace of mind that my home is paid off. And then also I could get a first position home equity line of credit like one of these right here, 280,000. And then if I need funds available, I could use my home as security, as collateral for funds that I can easily pull out, right? So again, there's a saying that the best financial decision is not necessarily the best credit decision, and vice versa. So that's why I took the route to pay off my home quickly. But as for the other debts, I paid those off too. So again, it's actually going to take you about 26 months, so that's a little bit more than 2 years to pay off all your other debts, and then your mortgage is about 4.57, right? So, what do you think? Do you think that this is going to cause a little bit of jealousy? Because I feel like human beings nowadays, it's so weird. Like we display our best moments on social media, but they're not even real. But then when you have something real, like paying off your mortgage under 3 years, like you can kind of feel there's a little bit of jealousy in there, even if they don't say anything. You know what I'm saying? All right, well, that's it for today. Have a great day. Good night. I might crank out another video before I go to sleep, and we will speak next time. It's Crane Atlanta Mentorship.